Investing might seem like a complex world full of jargon and confusing numbers, but at its heart lies a simple, powerful concept: compounding. This is the financial equivalent of putting your money to work so that it earns more money over time, and then those earnings generate their own earnings. It's like rolling a snowball down a hill. The further it goes, the bigger it gets. In this video, we'll introduce you to 9 of the best assets that can help your investments grow through the magic of compounding. These are tools that, with time and patience, can significantly increase your wealth. We're not just talking about putting your money in a bank account and forgetting about it. We're diving into various investments that, if chosen wisely, can offer returns much greater than any savings account ever could. The key to harnessing the power of these compounding assets is starting early. The more time your money has to grow, the more significant the impact compounding can have. Whether you have a lot to invest or are just starting with a small amount, these 9 options can set you on a path to financial growth. Let's get straight to the point and explore how you can start building your financial future today. Compounding is a bit like a snowball effect for your money. Imagine you have some money that earns a little extra over time, like getting $10 extra on $100. Now, instead of just keeping that $10 aside, you add it to your original $100. The next time you earn extra, it's on the new total, $110, not just the original $100. So, your money grows faster because you're earning extra not just on your original amount but also on the extra money you've earned along the way. This keeps going, making your pile of money grow bigger and bigger over time. Starting early is crucial with compounding. The more time your money has to grow, the more you will end up with. It's like giving your money more time to work for you. Even if you start with a little, time can turn it into a lot. Successful investors have used this simple trick to build their wealth over the years. They know that starting early and giving their investments lots of time to grow can lead to amazing results. That's the power of compounding. It's a way to make your money work hard, so you don't have to. Not all investments are the same. Some can do a lot more for your money than others, thanks to the magic of compounding. We're about to look at 9 different types of investments, each with its own special way of helping your money grow over time. Think of these investments like tools in a toolbox. Just like you choose a hammer for a nail and a screwdriver for a screw, you'll choose these investments based on what you want your money to do for you. These 9 assets are your best bet for making your money work harder and smarter, growing your wealth over time. Whether you are looking at the top crowdfunding websites, going for the best stocks to buy, or considering HSBC certificate of deposit. Now, let's dive right in. Number 1. Stocks. Stocks are like small pieces of a company that you can own. When the company does well, the value of your piece can go up. This means if you decide to sell your piece later, you might get more money than you paid for it. Plus, some companies give you a little extra money regularly, called dividends, just for owning their piece. This is their way of saying thank you for investing in them. Imagine you buy a piece of a company that makes toys. If more people start buying those toys, the company makes more money. Since you own a part of the company, your piece becomes more valuable. Over time, as the company grows and gives out dividends, your investment can grow too. This growth over many years is how stocks can help build your wealth, especially if you reinvest the dividends to buy more pieces of companies. This way, your money can start working for you, growing bigger as the companies grow. You should do your research before deciding on the stocks to buy. Number 2. Bonds. Bonds are like lending your money to someone, like the government or a company, and in return, they promise to pay you back with a little extra after some time. This extra money is called interest. It's like giving a friend $100 and them saying, "I'll give you $105 back in a year." That extra $5 is your reward for lending them money. When you invest in bonds, you're the one being paid extra for your loan. The nice thing about bonds is they tell you from the start how much extra money you'll get and when you'll get your original money back. This makes bonds a more predictable kind of investment compared to others. Over time, as you keep getting these interest payments, you can use them to buy more bonds or other types of investments. This is how your money starts to grow with bonds. It's a slower process compared to some investments, but it's also considered safer, making it a good choice for people who want a steadier path to growing their money. Number 3. Real estate. Real estate means owning property, like houses or apartments. When you invest in real estate, you can make money in 2 main ways. First, if you rent out your property, you get money every month from your tenants. It's like having a lemonade stand where customers keep coming back, giving you a steady stream of money. Second, the value of your property can go up over time. So, if you decide to sell it later, you might get more money than what you paid for it, like buying a toy on sale and selling it for more money later. Investing in real estate can be a powerful way to build wealth. The monthly rent can be a nice, steady income, while the increase in property value over time can be a big bonus. Plus, owning real estate is like having a physical piece of the world, which can feel more secure than owning pieces of paper or digital assets. Number 4. Mutual funds/ETFs. Mutual funds and ETFs, exchange-traded funds, are like big baskets of different investments. Stocks, bonds, and sometimes other things, all mixed together. When you put your money into one of these baskets, you're actually buying a little piece of everything inside. This is great because it spreads your risk. Instead of betting everything on one company's stock, you have a small part in many, which can be safer. Think of it like going to a potluck dinner. Instead of just eating the one dish you brought, you get to try a little bit of what everyone else brought. If one dish isn't good, you still have plenty of others to enjoy. Mutual funds are managed by professionals who decide what to put in the basket, aiming to make as much money as possible for you. ETFs are similar, but you can buy and sell them like stocks throughout the day. This makes it easy to start with a small amount of money and still have a well-rounded investment. Number 5. High-yield savings accounts. High-yield savings accounts are like piggy banks, but better. You put your money in, and the bank pays you more money just for keeping it there. The high-yield part means these accounts pay you more money than regular savings accounts. It's like if you had a magical piggy bank that added more coins by itself every month. These accounts are a safe place to keep your money because even if the bank has problems, your money up to a certain amount is protected. Plus, you can take your money out whenever you need it, without any penalty. This makes high-yield savings accounts a good choice if you want to earn more money on your savings without taking big risks. It's perfect for saving up for something big, like a car or a trip, or just to have an emergency fund. Over time, the extra money the bank pays you can add up, helping your savings grow a bit faster. Number 6. Certificates of deposit, CDs. Certificates of deposit, or CDs, are like special savings accounts where you promise to leave your money alone for a certain period, like 6 months or a year. In return, the bank promises to pay you more interest than you would get from a regular savings account. It's like agreeing not to touch a part of your dessert now, so you get an extra treat later. The catch with CDs is that you have to wait until the end of the agreed time to get your money back without losing any of the extra interest. If you take your money out early, you might have to pay a fee or lose some of the interest. CDs are a good option if you know you won't need to use your money for a while and want to earn more interest. Since the interest rate is fixed, you'll know exactly how much extra money you'll have at the end, making it easier to plan for your future savings goals. You should check out the HSBC Certificate of Deposit or HSBC CDs. Number 7. REITs, Real Estate Investment Trusts. REITs, or Real Estate Investment Trusts, are companies that own a lot of property, like malls, apartments, or hospitals. When you invest in a REIT, you're basically buying a small piece of all those properties. It's like being part of a big group that pools their money to buy a bunch of buildings, and then you get a share of the money they make from renting them out or selling them. One of the cool things about REITs is that they have to give most of their profits back to investors like you, usually in the form of payments called dividends. This means you can get regular money from your investment, which can be nice if you are looking for a steady income. REITs are a way to invest in real estate without having to buy a whole building yourself. They let you get in on the action with less money and less hassle, and you can easily buy or sell your share whenever you want, just like a stock. Do your research on the American REITs. Number 8. Crowdfunding platforms. Crowdfunding platforms are websites where lots of people can put in a little bit of money to support big projects. businesses, or even help someone's idea come to life. It's like when friends and family chip in to buy a big gift for someone. Everyone gives a little, and together they make something big happen. When you invest through crowdfunding, you're giving money to a startup or a project you believe in, hoping it will grow and do well. If the project or business succeeds, you could make more money back than you put in. It's a bit like betting on a racehorse. You're putting your money on the one you think will win, hoping for a reward later. Crowdfunding is exciting because it lets you be part of new ideas and innovations, starting with just a small amount of money. However, it's also a bit riskier because new businesses can fail. But if you pick wisely and the projects do well, you can help something great happen and possibly make a profit too. You should check for the top crowdfunding websites. Number 9. Cryptocurrencies. Cryptocurrencies, like Bitcoin or Ethereum, are a new type of money that primarily exist in digital form. They're like digital coins you can send to anyone on the internet without needing a bank. Investing in cryptocurrencies means you're buying some of these digital coins, hoping they'll be worth more in the future. Imagine you have a rare, digital trading card. If lots of people want that card, its value goes up, and you could sell it for more than you paid. That's how cryptocurrencies work. Their value can go up if more people want them. But, just like trading cards, the value of cryptocurrencies can go up and down very quickly, making them riskier than other investments. Some people have made a lot of money from cryptocurrencies, but others have lost money. It's like a financial roller coaster. So, if you're thinking about investing in cryptocurrencies, it's important to be careful and not invest more than you can afford to lose.